First of all, I will record this webinar so that those who couldn't join us today could listen to it later. Then the webinar will last 1 hour. And if you wish to ask questions during the webinar, please use the chat box. We will go through the questions, or Paul will go through the questions as they come up. I will ask you to remain muted with your webcam off. So thank you for doing that already. This really helps us to reduce the background distractions. So as I said, we're recording this webinar. We've also recorded our past webinars. So if you're new to Bluebridge, please go to our website, bluebridgelimited.com. In our blog section, you can see all past webinars. Let us begin then, and with that, I hand over to Paul.
Thank you very much, Anna, and thank you everyone for joining us here today for the Bluebridge DAC6 presentation on the hallmarks that affect corporates. So we call them the intragroup hallmarks because they mainly involve transactions between entities that are in a larger non-financial group. And as Anna mentioned, this is part 2 of our intragroup hallmarks, and we're going to focus on concrete examples of how these hallmarks will arise in real-life transactions and what the consequences of these hallmarks arising will be from a DAC6 reporting standpoint. On the 14th of April, we presented the part 1 of the DAC6 intragroup hallmarks, DAC6 for corporates presentation. And we explored these topics in a more abstract, high-level manner. We're looking at the hallmarks that target cross-border transactions between mainly related parties who are seeking to arbitrage, to take advantage of the differing tax treatments across jurisdictions. Whether this be the way that assets are valued in those jurisdictions, or that depreciation is applied on different parties, or merely just the different tax rates that are available to corporations in those particular jurisdictions. So during this webinar, we explored the underlying aims and the EU-wide interpretations of these hallmarks. For those of you who have not attended many of our Bluebridge webinars thus far, one of the main themes that we keep pressing to our listeners is that DAC6, although originating and envisioned to be a unified regime across all of the EU member states, has in essence fragmented into multiple different regimes. And that means one of the things that we try and do during our webinars is explain where these fissures between the different EU member states may lie. So there is perhaps not one single interpretation, but multiple interpretations that could be available. So in addition to discussing the various interpretations for these hallmarks, we also talked about what the mechanics would be where a cross-border arrangement meets one or more of the hallmarks and perhaps the main benefit test as required, and therefore must be disclosed or reported to the intermediary or relevant taxpayer's local jurisdiction. And for we've talked about that in virtually all of our webinars, but what made it different for the corporates is in many circumstances, it will not be an external advisor who incurs this responsibility for disclosing the reportable cross-border arrangement, but often it will be internal, in-house experts, internal advisors who have it. And we discussed some of the little wrinkles that will apply where both the beneficiary of the arrangement in question and the intermediary who either designed or promoted or provided the relevant services in respect to that arrangement are actually working in the same company. Now, due to the time limitations back in April, we examined these topics without a lot of accompanying examples. We didn't dig deep into the real life consequences of these examples. We more addressed them in an abstract manner, how they're written on paper rather than how they're perhaps applicable in the real world. And so as we've done with other of our webinars, we began with the abstract one as our part 1. And then for part 2, we provided a subsequent webinar in which we explored a set of concrete examples drawn from our experiences that are intended to highlight some of the interesting points and complexities around the application of these particular hallmarks to transactions and cross-border arrangements. So today we're going to do that for the intragroup hallmarks for the corporates. And we've devised three separate examples, three separate scenarios that we will use to address a series of concepts and hallmarks. And you see on the table on your screen in front of you, we have a brief description of the scenarios posed in each of the examples, and then which of the concepts and hallmarks that particular scenario or example implicates or seeks to explore. In the first one, we have what could be deemed like a paradigmatic example of corporate tax-driven behavior. And here we have a corporate group structure that holds intellectual property, IP rights, trademarks, brands, or IP specializations. They're held in a low tax jurisdiction, and it licenses the IP to the main operating businesses that are in high tax jurisdictions. And the concepts and hallmarks we explore in this first scenario include the main benefit test, the concept of an associated enterprise, and then four particular hallmarks. Hallmark capital C1 little a, it's a payment to an associated enterprise where the associated enterprise has no tax residence. Hallmark C1 little b little I, it's a payment to an associated enterprise who is in a jurisdiction with a 0 or near 0% tax rate for corporations. Hallmark C1 little b little 2I, this is where the recipient is in a jurisdiction that is on an EU or OECD blacklist, so for non-compliant jurisdictions. And then we see Hallmark C1 little d, and where payment is subject to a preferential tax regime. Moving on to example 2. We have a parent corporation with an offshore hybrid entity. I'll define that term as we get to it, benefiting from the differing jurisdictional treatments accorded the hybrid. So the one point maybe to address here is that we use specific jurisdictions, France, Hong Kong, Cayman, UK, Switzerland, places like that. Please do not think that we are making statements about the tax codes in those jurisdictions. Those jurisdictions were selected more for their symbolic value. So obviously, France would be symbolic for a jurisdiction with a fairly high tax rate, but with a lot of production facilities and income earned within that jurisdiction. Whereas a Cayman or a Hong Kong might be more symbolic of an offshore financial center, where perhaps the economic activity doesn't take place, but some of the income is funneled towards for tax or other reasons. And in this particular example, we'll be looking at Hallmark C2, depreciation on the asset in multiple jurisdictions, and Hallmark C3, relief from double taxation in multiple jurisdictions. So keep in mind, just because we have a certain scenario where there's multiple times people can claim double taxation relief in Hong Kong and France, does not make it so. Example number 3, we have an asset transfer amongst parties, could be related parties or unrelated parties in different jurisdictions with the differing tax treatments on non-DAC6 topics. So Hallmark C4 is where we have a material difference in the price, the tax value of the asset once the transfer is accomplished. And then we have the Hallmarks E, which are the transfer pricing hallmarks under DAC6. In Hallmark E1, we have what are called hard to value intangibles. And in Hallmark E3, we have asset or even functions transfer with a massive, significant EBIT impact. That's earnings before income and depreciation. And so there's a particular hallmark that applies directly to those situations. So that is the table of the illustrative examples. It can second as our table of content for today's session. And I'm going to launch into them right now. So here we see illustrative example number 1. We have a corporate holdco that is located in France, and it's owned by a Swiss person and a French person. And at a minimum, amongst other activities, perhaps, this corporate holdco holds the following 3 subsidiaries, wholly owned subsidiaries: an operating company in France, an operating company in the UK, and then an IP holding company that's located in Cayman. And we're going to consider what happens from a DAC6 standpoint if the following transactions take place. So in theory, the IP holdco holds all of the IP of the non-financial group, and then it licenses this IP for use in France or the UK to these operating companies. And of course, the operating companies have to make royalty payments back towards the IP holdco. So what happens when the French operating company makes a royalty payment to the Cayman IP holdco? Well, what we're going to be looking at here are the deductible payments made to associated enterprises. That's the general topic for these Hallmarks C1 that we have here. Now, 2 quick points, which I will go into, is deductible payments basically mean any expenses, reasonable expenses incurred in the operation of a business that are not capitalized. So these are not for capital assets. A capital asset is a building or a machine in which over the course of time, you're able to take depreciation upon. Whereas a deductible expense is an expense that you can use to reduce your taxes in the year in which you do it. That can be the salary you pay to your employees, that can be interest payments on loans, or in this scenario, that can be royalty payments for IP or other things that you've licensed. The associated enterprise definition it's a related party definition. So at what level of joint ownership would you treat 2 distinct entities as more connected and not acting towards each other as they're not treating each other as completely third parties? So it seeks to identify the area where the laws of the market no longer apply to all the transactions, because in an example where you have a holdco and an operating company, you could do a deal that's very beneficial for the holdco and not beneficial for the operating company. But what really matters is that in the aggregate, it really benefits the corporate holding company. So it helps if you have a consolidated balance sheet, but it can be further afield. It can be people who own these companies and somehow are able to exercise control over them and arrange for transactions that, again, don't specifically benefit each of the companies individually, but do as a whole benefit the owner of those companies. So this is associated enterprises and deductible payments. That's what we're looking for as a basis. And clearly, where we have a royalty payment made to a sister company, so from the operating company in France to the IP holdco in Cayman, both of these standards are squarely met. So let's look then to HMC 1A, the payment, deductible payment, we have that. To an associated enterprise, we have that. And the associated enterprise has no tax residence. Well, as many of you will know, Cayman does not have a corporate tax rate. And therefore, Cayman has no need to define corporate tax residence for purposes of its income tax, its corporate income tax. Maybe it has to for other purposes of CRS or FATCA or something like that, but it does not have what's generally referred to as a definition of corporate tax residence. So then you would say, okay, so it has no tax residence and therefore this hallmark should be met. That is not the case, in fact. So this hallmark is not designed to capture jurisdictions that do not have a corporate tax rate and therefore do not have a definition of corporate tax residence. What they're trying to ferret out are stateless corporations. It's a much smaller group than corporations located in tax-free jurisdictions. And a stateless corporation is a corporation that is set up in a way that it avoids being subject to the laws of any jurisdiction for taxation matters and possibly other matters. And the way this works is certain jurisdictions will have a strict definition of corporate tax residence that applies to anyone who is established or incorporated under the corporate laws of that jurisdiction, okay? Other jurisdictions will have a standard that says, no, you are resident where you are effectively managed and controlled. Okay, many jurisdictions will apply both, have a hierarchy. there's a variety of them. But in an example where you had two jurisdictions, each one applying a strict version of these two distinct standards for the definition of corporate tax residence, it would not be impossible to set up the company in the jurisdiction with the effective management and control standard, manage it out of the jurisdiction with the strict place of establishment standard, and therefore result in a stateless corporation. This is purely theoretical because I've never actually seen one of these, but I'm sure they exist because if it's possible, it's done. However, the point here is that Cayman, a corporation set up in Cayman that would be subject to Cayman tax if there were a Cayman corporate tax does not satisfy HMC1a. But anyone who's been reading ahead on the slide is going to be pretty sure that we do satisfy the next hallmark, HMC1i. Here we have a deductible payment, check, to an associated enterprise, check, and that associated enterprise is subject to a 0% or near 0% tax. As mentioned a moment ago, Cayman has a 0% corporate tax rate. So this particular payment would seem very much to qualify as a reportable cross-border arrangement subject to disclosure under DAC6. However, for that particular hallmark, as with about half of all of the total hallmarks, there is a second criterion that must be satisfied before the cross-border arrangement becomes reportable. And that is referred to as the main benefit test. Now, we've talked about the main benefit test a lot on these webinars, so bear with me, those of you who have been attending regularly. In fact, we even have an entire webinar based on this topic because it's varied, it's diverse, fragmented across the EU and quite complicated the way different jurisdictions have addressed it. But I'm going to address it in a fairly simplified manner today and just share what the version of the main benefit test included in the DAC6 directive is. And that's queries whether the main benefit or one of the main benefits, having regard to all the facts and circumstances around the transaction, that a party may reasonably expect to derive from a cross-border arrangement is the obtaining of a tax advantage. Well, it's not hard to see here that having IP in a tax-free jurisdiction and licensing that IP to your operating companies in higher tax jurisdictions has a real tax advantage to it. It can sharply reduce your aggregated, your consolidated effective tax rate. And it's, of course, one of the headline issues that we've seen in recent years, whether it's Starbucks or Amazon, or any number of companies holding their IP in a certain jurisdiction, and they're reducing their overall tax outlay by charging strenuous, let's say, licensing fees, which can reduce the income of the operating companies, but are not taxed in the jurisdiction of the IP holdco. So I think pretty clearly that the main benefit test will be met in most circumstances here. Now, an interesting wrinkle could be where the IP is actually developed in Cayman as opposed to transferred there. So in many circumstances, the IP will be developed in a France or a UK or US or Switzerland or wherever you are, but usually not in a Cayman or a BVI or Channel Islands or a more or a place like that. And though typically what happens is it's developed in a larger country, and then it's transferred over to the IP holding jurisdiction. And in those circumstances, obviously, you're going to have transfer pricing issues as well. But you also then, it'd be hard to argue that tax wasn't the major motivation for sending the IP to the non-tax jurisdiction and setting up this whole licensing process. However, if you had developed the IP in that particular jurisdiction, you could make a defensible argument that this particular transaction was not tax driven. This particular transaction was driven by the need for the French operating company to obtain a license for this IP and the royalties that it therefore has to pay. the consequences of which are perhaps have a tax benefit to the overall company, but are not one of the main benefits of this transaction. That might stand up. It's worth looking through to see if you can make the claim. On the other hand, what I would expect is that the tax authorities will then step back and say, okay, but the reason you set up your IP development operations in the non-tax jurisdiction is because you foresaw the tax benefits that you would derive from it. So perhaps that will work, perhaps not. It depends perhaps on some of the other circumstances around there. But that was, I thought, when it occurred to me, was an interesting wrinkle, because you don't usually see the IP developed where it's held in a situation like this, in a tax-driven situation. So in my view, I think this would clearly qualify as a reportable cross-border arrangement, irrespective probably of whether the IP was developed in Cayman or just transferred over there. Now let's look at the next hallmark, which is C1 little b little 2I. Now this says, is the jurisdiction of the associated enterprise, the recipient of the deductible payment, is it on a blacklist? So the EU and the OECD, they maintain these blacklists that they update on a regular basis, but they use it in order to exert significant pressure on these jurisdictions to improve various parts of their financial regulation and tax. Well, let's say to come into line with the EU and the OECD wants them to do from a tax perspective. Now, Cayman is not on that list. The only jurisdiction of real interest, I think, to European countries at the moment that is on a list is Panama. And Panama, of course, is a major flag of convenience. So shipping companies are particularly interested in Panama being on a blacklist. So here you could say, okay, no problem. This payment was made, but Cayman's not on a blacklist, EU or OECD anymore. So this will not trigger reporting. That's fine. But what's key to think about here is that the timing of the blacklist. So when we have a situation like this, where one party is licensing the IP, chances are there was a contract made and the contract runs for 5, 10, 20 years, however long is relevant for the particular industry. If you look closely, though, at the DAC6 language, they don't talk about when was the contract set up to make these deductible payments. They ask when the deductible payment was made. So it would be possible for this arrangement to have been set up today or years ago and be not subject to disclosure under this particular hallmark, but in 5 years, when the contract is still running, then you might have Cayman, for some reason, I don't think it will, but for Cayman to end up on the blacklist, in which case, all of a sudden, all of these IP royalty payments made into Cayman are going to be subject to disclosure under DAC6. So that's something to keep in mind, is that if you're in charge of setting up these arrangements, you may want to future-proof them somehow by perhaps allowing the contract to be annulled if the jurisdiction of the IP holding company ends up on an OECD or EU blacklist. If it's worth it, just something to keep in mind. It may not be worth it. I mean, disclosing something like this is not going to get you in trouble, of course. Okay. And now we go to the final hallmark that we're going to look at in illustrative example number 1, which is payment is subject to a preferential tax regime. Now we can ignore Cayman for now. Cayman doesn't need a preferential tax regime because its entire tax regime is preferential, if you will. You can't get much better than 0%. But in other jurisdictions, including many EU ones, including Switzerland or Luxembourg and many other places, they have specific reduced tax rates for certain types of activities. And you can find this for software development or IT development. You see that. You see it with shipping tonnage tax. That can have a reduced effect on the taxes for shipping companies in order to encourage them to operate out of their jurisdictions. But by far the most popular one is a patent box or an IP box. And here you would have a jurisdiction that says, okay, we have a 10, 20% tax rate for normal corporate income. However, If you can establish that that corporate income is tied to intellectual property licensing fees, then it gets reduced to 10% or 5% or whatever is appropriate. So in that situation, if we had the French operating company paying into an IP holdco in a jurisdiction where that particular type of income was subject to a lower tax rate than the normal corporate income is, then you would have HMC1D satisfied on the surface. Now here we come to one of those fragmentations that we're seeing in DAC6 across the EU. The EU itself has looked at preferential tax regimes and has split them into harmful and non-harmful types of preferential tax regimes. And while the DAC6 directive itself says nothing about the harmful versus non-harmful distinction, it just refers to preferential tax regimes, certain jurisdictions in the EU, such as Cyprus and a few others that have such preferential tax regimes on the book, that have been deemed to be not harmful by the EU, have taken the position that preferential is synonymous with harmful. And therefore, if the tax regime is not harmful, then even if it looks like a preferential tax regime and acts like a preferential tax regime, there is no disclosure requirement under DAC6. Now, here we have an interesting problem that might arise in that where you have this particular type of arrangement between entities in two different EU member states, you may come into a situation where one adopts the harmful equals preferential equals harmful and the other does not. And you may see where it becomes reportable in one jurisdiction, but not another jurisdiction. And this can be particularly troubling where perhaps the two entities involved, the ones who would normally have the disclosure responsibilities under DAC6, perhaps they would both treat this as harmful, preferential equals harmful, and therefore they would say something that's not harmful is not preferential, so doesn't meet DAC6. But what if there is a so-called relevant taxpayer, so the beneficiary of the tax advice? What if they're in a jurisdiction like Germany, for example, that completely jettisons the harmful, non-harmful distinction? Then you're looking at a situation where the payment subject to the preferential tax regime is not a reportable cross-border arrangement in the jurisdictions of the intermediaries, and therefore you think fine. But then you have to look to see if it's reportable in the jurisdiction of the relevant taxpayer. And if it were, the reporting responsibility under that particular hallmark should fall on the relevant taxpayer. So you can see where the fragmentation across the EU is creating a whole raft of unexpected and really unwelcome, unintended consequences. Okay, so that's what happens when France, the operating company in France, makes the payment to the holdco in Cayman. It's disclosable almost certainly because it's a payment made to an associated enterprise in a jurisdiction with a 0% corporate tax rate. And it's almost certainly going to satisfy the main benefit test because so many of these situations are, in part at least, tax driven. What if the UK OpCo does the same? What if they make the payment? I mean, your first thought should be, well, it's exactly the same, right? I mean, what's the difference? And analytically, there is no difference. Except there's two questions you want to be asking yourself. First, is this even a cross-border arrangement as defined under DAC6? Now, clearly it's cross-border under the normal English use of the language, right? It's going from the UK to Cayman. However, for it to qualify under DAC6, there's a jurisdictional element to that as well. And that jurisdictional element suggests that it needs to concern an EU member state needs to be involved in it, and it needs to concern that, an EU member state needs to be involved in it. And as anyone who's followed any news in the last few months knows that the UK is no longer an EU member state. However, last I checked, the UK will continue to be treated as an EU member state for purposes of DAC6, meaning that this is in fact a cross-border arrangement, even though it doesn't seem to have any EU countries involved in it. Okay. Fine. So then the analysis is the same as with France. Well, hold up. One thing that the UK has done, although they haven't pulled themselves out of DAC6, what they've done is they've reduced the number of hallmarks that are applicable to UK parties drastically. And they've thrown out hallmarks A, B, C, and E. And they've only kept hallmarks D, which are the CRS related ones and the opaque offshore structure related ones that are proposed and set forth in the OECD's mandatory disclosure rules. So in fact, if you did the exact same analysis that we did for the French company, you would look at this and say, well, any of these examples of these deductible payments to associated enterprises may be true, but none of these are hallmarks in the UK. Obviously, Cayman is not subject to DAC6, and therefore there is no need, there is no disclosure obligations for this particular cross-border arrangement. Wait a tick, because as I mentioned before, you don't just look at the intermediaries, you have to look at the relevant taxpayers as well. And in this circumstance, the relevant taxpayer, a beneficiary of these particular arrangements, is going to be that corporate holdco that is headquartered, resident in France. And as we've just discussed, all of these hallmarks are applicable under the French version of DAC6. So even where the UK operating company may escape having to do any disclosure based on this, the corporate holdco in France may need to take up the slack and do the disclosure on this arrangement because its two subsidiaries have entered into it. And by a quirk of DAC6, even though those subsidiaries are no longer EU member states, one of them is still treated as an EU member state for however long that lasts. I can't really see that lasting. It doesn't make a ton of sense, but I don't know what deals they've set up. Another thought here is, what if that corporate holdco were in Switzerland? Well, then we wouldn't have any jurisdiction where subject to DAC6 for any of these entities where these particular hallmarks are applicable. Then you have to ask them, but what about that dude in the bow tie and the black who's from France, who owns this whole group? Does he qualify as it? That's a tricky situation. It kind of depends on how much control he's going to exercise over this whole enterprise. A publicly traded company, I can't imagine, but if it's a privately held concern of which each party holds an equal share, then you probably are going to have a strong argument that he becomes a relevant taxpayer with respect to this particular cross-border arrangement. You apply the French rules for hallmarks to this transaction, and you would find out that it does in fact qualify as a reportable cross-border arrangement, and you have an EU party with an obligation to disclose it. So once again, we see the fragmentation throwing up unexpected consequences for DAC6 disclosure responsibilities. Okay, I'm going to move on to illustrative example number 2, unless I have any questions on this that anyone wants to discuss. No. Okay. Here we go. Okay, number 2. Here we have a parent company, French once again, and it has a hybrid entity subsidiary in Hong Kong. Now, a hybrid entity, for those unfamiliar with the term, is an entity that is treated differently in the jurisdiction where it's located and the jurisdiction where its owner is located. Famously, check the box under the US laws is a famous example of how hybrid entities can be created for tax advantage reasons and non-tax advantage reasons, but tax advantage reasons. So in this scenario, this Hong Kong subsidiary is treated as a partnership or a flow-through entity in France, meaning that all of the income that the hybrid earns is deemed to flow directly up to the parent company as if it had been earned directly by the parent company. However, in Hong Kong, the hybrid is treated as a taxable entity, as a corporation. And this creates, let's say, planning opportunities that people may take advantage of and that the DAC6 is looking to identify. So we're going to look at the following transactions. In transaction 1, the subsidiary purchases machinery, which is an item of depreciable personal property, right? in transaction number 2, the parent company leases an aircraft to the subsidiary. And in transaction number 3, the subsidiary receives a payment from the US, which is subject to withholding by the IRS. Okay, so let's start with scenario 1. The sub purchases machinery. First question is this a cross-border arrangement? Well, to be a cross-border arrangement, you need not only that EU jurisdiction in the mix, but it also has to concern more than one jurisdiction. And at first impression, you basically have, assuming that the machinery was bought in Hong Kong from another Hong Kong company, which is normal, I suppose, there's no cross-border element. It's a purely domestic interaction. You buy it, it depreciates, you claim depreciation reductions in Hong Kong, and that's that. Except because of the treatment of this entity as a hybrid entity, the parent company may be entitled to take depreciation on this as well. And so what makes this a cross-border arrangement for DAC6 purposes is not the purchase of the machinery or anything you do with the machinery, but it's the tax implication that it has in a different jurisdiction. It doesn't even need to have money flowing up there. They can just, they're just entitled to it. It's a deemed activity, phantom depreciation rights. But the moment that the French parent company exercises those rights, boom, you have a cross-border scenario. So in this situation, assuming that the laws of tax codes of France and Hong Kong so allowed for this, making no opinion on that, you could have the hybrid corp treated as a fully taxable entity in Hong Kong, taking a depreciation deduction on the machinery it's bought. From the French standpoint, however, that machinery is owned and operated by the French parent co because the hybrid is treated as a flow-through entity. And therefore, all the tax attributes flow up to the parent company, including the right to take depreciation on any depreciable property that is owned by the company. So in this situation, you could easily meet HMC2 because you could have depreciation on the asset being taken in multiple jurisdictions. Okay. Now, let's look at a similar scenario, except this is going to be the lease scenario. So what happens when so parent company in France buys an airplane, parent company in France leases the aircraft to the subsidiary. Are both entitled to take depreciation on the aircraft? It depends on the particular tax rules, but it is possible. In fact, it is not that uncommon for this scenario to reflect the differing tax rules. The chosen jurisdictions will reflect the differing tax rules. And here what you will see is in one jurisdiction, the true beneficial owner, which is the French parent company, is entitled to depreciation on the aircraft. Okay. In Hong Kong, though, perhaps, or in whatever jurisdiction you have, it's not the parent company, but the lessee who is entitled to take the depreciation off of the aircraft. And in that case, you could have depreciation on the asset in multiple jurisdictions. Now, an interesting question could arise where the depreciation in Hong Kong is not necessarily taken on the aircraft, but on the leasing contract. And then you would have where you could say, well, the depreciation is not taken on the asset, but it's two separate assets. One is the aircraft and the other is the contract. I don't think that would hold up, but I'm certain someone will give it a go. Now, this also depends on there not being sort of a tax. No, I should save that one. Let's save that one for the next example. So here you can see in the leasing standpoint, or leasing of anything, where where both parties can take depreciation on it. And they don't need to be related parties because, of course, the value of the depreciation will affect the price of the contract. So both parties will benefit both in their home jurisdictions and vis-a-vis each other in the contract if they're both allowed to take depreciation on the asset. Okay. Transaction number 3, the Hong Kong sub receives a payment from the US that is subject to withholding. Okay. So here we have the US, the dollars coming in, they're withheld upon by the IRS under qualified intermediary regime, for example, or other international tax matters. But Hong Kong says, okay, we take that into account. We're going to deduct your Hong Kong tax bill based upon the US withholding tax, okay? the French do the same thing. We'll deduct your French tax bill based upon by the amount of the U.S. withholding tax. Now, in certain circumstances, that's fine. That will not result in relief from double taxation. That will be how the system works when the credit system between France and Hong Kong is set up to allow it to work. To illustrate this, I'm going to just throw some numbers at you. Let's assume the payment from the US is $100. Let's assume that the withholding tax in the US is 10%, so $10. Let's assume that the relevant corporate tax rate in Hong Kong is 20%, so $20. And let's assume that the relevant corporate tax rate on this payment in France is 30% or $30. Well, let's look at it. So the money goes into Hong Kong. It's $10 is taken out by the US. Hong Kong says, okay, we want $20 off of this payment, but we recognize we have a treaty with the US, for example, and the US has taken its $10. So we're going to credit you those $10 and we're just going to take $10 more. The end result being the total tax rate is now 20%. Okay. France looks at the same thing. They say, okay, the US took $10. Hong Kong took another $10, so we're just going to take $10 more, and then the end outcome is going to be that it's subject to $30 in total tax. And we have all these double taxation treaties that mean that this will balance out for us in the end, so we're all happy with it. Great. What if, though, instead of looking at the Hong Kong tax as including the relief from double taxation, they took the whole amount of the Hong Kong tax, and they added the US double taxation relief to it. So now the French parent company is saying, okay, well, you paid your 20% taxes in Hong Kong, plus you have this $10 that the US took. So we're going to credit you $30 on this payment, and therefore you don't owe us anything, because we see $10 taken from the US, we see a $20 tax in Hong Kong, that's $30. That's what we think the correct tax is on this payment. And so you don't owe us anything more. In which case, of course, the parent company is now benefiting from $10 extra that it wouldn't have had otherwise if it were not able to double up on the relief from double taxation in multiple jurisdictions. Okay, that's illustrative example number 2. Unless there's any questions on there, I'm going to move on to example 3. All right. So here we have an asset transfer amongst parties in different jurisdictions. These companies are not related to one another. The US operating company is selling a software program to the French operating company. This is not a license. This is a software package, right? So it's not a licensing fee, but you're actually buying the software. However, the French company will be paying in annual installments. So the cost of the software is, say, $100, but instead of paying $100 up front, the French operating company pays $10 up front and $10 for the next 9 years, I guess you'd say, but 10 years is the way most people would think about it. Okay. So in the first example, again, that doesn't need to be related, we have a transfer with potentially a material difference in price. Now, why would you have a material difference in price? If it's an arm's length transaction between related parties, why wouldn't it just be $100? That's what you sold it for. Well, it's the installment sale aspect that changes the calculus of what the software will be priced at in one of these jurisdictions. Let's say it's in the US. So let's say in France, they ignore the installment aspect and they say that's worth $100. In the US, they're not going to see this as a $100 transfer. What they're going to see is you paid $10 and you borrowed $90 from the US. Now, that doesn't mean it costs you $10. What that means is of the total $100 that you end up paying, leaving aside time value of money, out of the total $100 you're paying, a certain amount of that has to be attributed to interest that you paid on the $90 loan that you took out, the 10-year $90 loan that you took out on the day you made the sale. For the sake of argument, let's say that interest equals $10. And then from the US standpoint, this is two transactions. This is $10 worth of interest being paid and $90 being paid for the actual good that you have, in this case, sold or could be purchased, of course. Now that means in these two different jurisdictions, there is a difference in the price for tax purposes. Now, the trick here, and again, fragmentation across the EU, is this word material. Is $10 out of 100 or $10 out of versus 90? What is that, 10%, 12%, depending upon which numbers you choose? Is that material? In some jurisdictions, it will be. In some jurisdictions, it needs to be a 25% difference in order to be material. So in many circumstances, especially when you have this constellation between two EU member states, you're going to have to look not only at the different internal tax rules regarding the pricing of assets and such transfers, installment sales, but you're also going to have to look at what the definition of material is in order to determine whether you have a disclosure obligation under DAC6. Okay, now we're going to move into the transfer pricing hallmarks. And for transfer pricing to be applicable, the companies have to be related. They don't use the term associated enterprise for the related parties under the transfer pricing hallmarks, but the EU has made it clear that they should be synonymous. So these are associated enterprises, so joint ownership to a sufficient enough degree of control that they're not completely independent third parties from one another. Okay, now, as a brief introduction to how transfer pricing works, if anyone's not familiar with it, what transfer pricing laws try and do is they try and figure out for a transaction between two related parties, they try and figure out what the actual pricing of that transaction would be if it was an arm's length transaction. So if you had two unrelated third parties with pure market forces determining the price of the transfer, what would be the value, the cost paid for, in this case, the software program? Because as we noticed in example one, if you have a certain setup with a low tax jurisdiction versus high tax jurisdiction, you have a very strong incentive to charge a lot of money to the high tax jurisdiction in order to earn a lot of money in the no tax jurisdiction. And the tax authorities don't like that, so they try and figure out what the actual market value of that transaction would be, and they look for what are called comparable transactions in the marketplace. So what would this software cost the French company if it were truly independent from the US seller of that software? You would find as many examples that as closely correlate to this as possible, and the best that support your case on either side, and then you would claim that this is the correct pricing for this particular transaction. That doesn't always work though. And one of the times that really doesn't work is where you have what are called hard to value intangibles. So in these scenarios, not only do you not have comparables that you can find because it's a unique enough transaction that there's not a lot of comparables out there, or so many of these transactions take place within one larger group that none of these transactions can truly be considered arm's length transactions. In addition, for DAC6 purposes, the hard to value intangible meets the following criterion: that at the time the transaction was entered into, the projections of future cash flows or income expected to be derived from the transferred intangible are very difficult to predict. So in a situation where the software, if it was a very common software program, A, you could find a comparable, or B, you could project out what the earnings by the French operating company would be, and therefore you could come up with some value, some neutral value that you could ascribe to this transaction. But what if the software program were revolutionary, had never been seen before? You don't know then. Will it take off? Will it be a big success? Will it be Google, or will it be Bing? Will it be Spotify, or will it be some player that had similar types of technology but never took off, right? So in those early stages, it's extremely difficult to estimate any sort of income flow that you will get from a particular piece of intangible property. Okay, so in that scenario, if those conditions were met, then this particular transfer would be a hard to value intangible and would meet the Hallmark E1. Yeah, okay. And then we look at Hallmark E3, and here we see where the asset or a functions transfer has a big impact on EBIT, so earnings before income and depreciation. It's also known as your sort of operating profit. So if you take out the tax elements, how much money are you actually earning through your operations? Now, let's say this software program wasn't just one of the software programs, and it wasn't just being sold, the IP wasn't just being sold for limited use, but it was everything in the operating company in the US. And they transferred basically their sole purpose of being this software program, their sole earner of income, over to France. For whatever reason, they did it. Well, if you looked at that, then you would have to consider Hallmark E3. And yeah, and so if at the end of this scenario, this would be after, you would actually have to do the financial calculations subsequent, I think, to the transfer. Would the impact on the earnings on the US company exceed, I believe it's 50%. I don't have the number right here. But it's significant profit shifts, 50% or more following the transfer or functions. I mean, in certain circumstances, it will be clear. If in fact, all this US company was doing was developing and then holding this software and it transferred it all to a French company, then sure, the earnings for the US company are going to drop much more than 50%. However, in other circumstances, it won't be clear until afterwards what the impact on the financial statements for the companies will be. One interesting point here is, I love to harp on, is you don't have to have an asset transfer. In fact, you don't even have to have what's normally considered to be a taxable transaction of any sort. DAC6 takes a very broad view on what qualifies as a transfer, and it also looks at a functions transfer. So what if this software was not, it wasn't the software that was transferred, but the software development team, that was all of them were sent over to the French sister company to start developing software there for whatever reason. There's nothing taxable, I mean, wage, salary tax and stuff, but there's nothing taxable about moving jobs for people within a company. That's not a taxable incident most of the time. So you wouldn't even think then that there might be a tax disclosure obligation. But if in fact moving the whole software team from the US to France results in a 50% or more drop in the earnings before income and depreciation of the US company, that would meet the standard under Hallmark E3, and consequently that transfer, everyone moving jobs from the US to France, would have to be disclosed as a reportable cross-border arrangement under DAC6. Okay, so that's it with the examples. If I don't have any questions, which I don't seem to have any questions. Nope. I'm going to close on the key takeaways. So key points that I want to drive home to you for those of you who have joined us today. One, it's a pretty intense impact. There's a lot of different things you need to think about and put together to understand whether DAC6 is going to apply to a specific transaction or not. The whole concept of intermediary disclosure is pretty novel, and the analyses are broad under DAC6. I mean, we've focused on the intragroup hallmarks today, but I've also referenced things like transfer pricing and CRS, and there's other more classical tax shelter scenarios there. So you just have to have a broad view and a detailed understanding of what's going on in order to really understand what the impact of DAC6 could be. In addition, the timeline is really tight. It's not an annual reporting deadline like is most common in tax regimes, but it's actually a rolling 30-day deadline. So whatever the trigger date is, the date of the payment, the depreciable payment that you made, you have 30 days in which to analyze, prepare the report, and submit the report to your local tax authorities, provided it's a reportable cross-border arrangement. Point number 2, and I have harped on this quite a bit today, pan-EU fragmentation. Due to variations in local treatment of relevant tax topics, depreciation, installment sales, asset valuations, relief from double taxation, plus the differing interpretations adopted for DAC6 itself. The key DAC6 analyses will vary across EU jurisdictions. What's reportable in one jurisdiction is not necessarily reportable in another, is not necessarily reportable in a third for entirely different reasons. Then strict liabilities. So anyone who has a reporting duty, whether you are the intermediary reporting party or whether you are the so-called relevant taxpayer, it's a strict liability. There are no excuses, there are no exceptions, there are no de minimis limits. There is no ignorance defense that I had no idea. I had no idea this thing was going to benefit me. I'm just an investor. I'm not a party really focused on this. Doesn't matter. If you qualify as an intermediary or relevant taxpayer and everything lines up to make you the reporting party, you have a reporting duty. And if you neglect it, you are subject to penalties under DAC6. And then the final thing is the availability of reporting solutions. While everyone is in the market offering DAC6 consulting options, BlueBridge is the only DAC6 analysis and reporting service that can offer you freedom from all of your DAC6 compliance concerns, including potential liability relief. As Anna mentioned at the onset, we will convert the reports into the proper format for you and send them back to you for you to submit. We will take the statement of facts you provide us and we will tell you whether you have a reporting obligation based upon your specific circumstances with regard to that transaction. However, in your best circumstance, if you let us into the deal beforehand and we can advise you on the DAC6 reporting consequences of the deal in advance of the deal going through, we can actually assume the reporting responsibilities on your behalf. And if we do so, we will send you a unique confirmation number for your files. And if anyone ever comes knocking, asking why, internal audit, external audit, why you didn't submit a report on this particular transaction when it was reportable under DAC6, you can merely point to this confirmation number and say, I didn't have to. BlueBridge took care of it for me, and if they didn't do it right, they're at fault, they're liable, not me. Okay, thank you all very much for joining us today. We're gonna have more of these webinars upcoming, so keep your eyes open for your inbox, and we look forward to seeing you again. Bye, everybody.